Today we have Zia Mohi as always, and we have an amazing guest, Kenma. Thank you so much for joining us today. I'm just gonna give to our guests a little bit of background about you, and you are more than welcome, people, to ask your questions at the end. Ken and Sia will be answering them for you. And then today's going to be a very different podcast. We're going to talk about recruitment, leadership, and also, entrepreneurship, and also a lot of things that Ken has done in the past that definitely we want to talk today, especially in the world of tech, finance, data. We want to hear you, Ken. So just a little bit of background, something super quick about you. Ken is a visionary with over 2 decades of experience in fintech, data science, and AI. You have also have key leadership roles in very big companies, and you're also very keen to driving digital transformation and shape the future of finance. Also, you are a partner with Legendary Ventures, and you have a lot of expertise in technology, and definitely make you a true pioneer in the startup in the capital space. Ken, do you want to talk a little bit more about you?
Yeah, so I guess my whole journey is not really the conventional journey, like what most people would think. Usually, people who make an adventure either you have like three different paths. One path, you get your MBA, you work at some investment bank, Goldman Sachs, J.P. Morgan, etc. Then you kind of network your way, get some experience, and then you end up hopefully as an analyst to associate to becoming on track to being a partner at a firm. That's kind of one way. The other way is, you won the family lottery. Your family has a lot of money. Say, hey, I'll give you some money. You can start a fund. And then the third way is kind of, you either become a founder and you create something really great and you exit that company, you have a bunch of money. Or, the traditional route is kind of like, yeah, I'm going to work 25 years in corporate, make my way to an executive, have some money, have some connections, and then kind of rally my way to, joining a firm and or maybe even creating a firm. I think those are kind of the three ways that are mainstream. I think for my way, it's not traditional because I didn't really go along those paths. I don't have an MBA. I have a chemistry degree. I'm supposed to be a doctor. Like being in venture and finance is, it's not what I thought I would be in at the very beginning. I was supposed to be a doctor. It's kind of a weird, Asian joke. My parents wanted me to be a doctor. A lot of my family members are dentists. I took all the tests to get ready to become one. I realized I didn't want to do that. And kind of the way that segued me into, getting into finance and venture and startups was in college. I met a person who was like, "Hey, let's create this ice cream shop and let's do all these things." And it's kind of it was a weird scenario because a lot of people would think, why would someone want to make ice cream in college? I looked at all the different like options of what we could do, and then I found something that was kind of creative, which at the time, 2014, 2015 era, we were essentially making ice cream with liquid nitrogen. So essentially, you can flash freeze the ice cream before ice crystals are formed with water. So it's not that frosty flavor. It's kind of more of a smooth, smooth flavor, and it's more oxidized. So the net effect is you can essentially make ice cream without adding as much sugar, and then it becomes sweeter, and then you have this cool effect of fumes coming around. So that wasn't really popular in Wichita, Kansas, and I've seen it somewhere on the West Coast, Japan, etc. So we essentially did that. I think for about 3 or 4 months, and then the other people that were working on it with me essentially bought me out. So when they first kind of demoed it at a couple of fairs, they're doing about $2,000 a month or so. When I stepped in, I really looked at the operational bit, and I really looked at like how do we have these people that are behind the counter and train them to be quote unquote sales experts in a way where they can go outside of the station and be able to sell ice cream to people that were walking by, right? So essentially people are like, hey, ice cream's ice cream. You try to put it out there, people are going to say, oh, I'm going to go buy it. Well, in the case of our scenario, that wasn't really, like nobody really cared. You can get ice cream anywhere. So essentially we use the cool effect of the fumes and then the operational bit of training this sales team to go out and talk to people. And our location was really a key factor for that. So, in the mall, there's about 8,000 people going through the mall every single day. Me getting people to go outside of the stand and then actually talk to people actually convinced, maybe about 2 or 3 people at the start to like stop. And what I realized is the more people you stop, the more people realize they were like, well, what the heck's going on? And then you would see the fumes go off, right? And so more and more people stopped. Eventually, I was able to scale that business from $2,000 a month to the first month that I was in operations was about 42, and then 43, and then 46,000. And then month 3, they bought me out. I used that money, paid for college, bought a nice car, and then essentially I took some of the money and put it into stock market. Picked up things early on like Fitbit. It's like a $2 stock before Google came in and bought them. Had GoPros, $2. I had Zag. These are all like random companies that people didn't really know about at the time. I think I also picked up Starbucks in the early 2015 or 16, sometime around there. It was like $20. Sold it for $100. I got Snapchat at $5, sold it at $60. Etsy was $27, went to $232. Essentially made all this money, and I tried to figure out like, okay, well, if I can do this publicly and invest, I'm not really like a licensed, not a licensed investor or anything like that. But people were saying, hey, you made all this money. How do I give you money? And then you can help me invest. And I looked at all different ways. And, that wasn't really like, it was just not possible to do without the licenses. So the alternative was, I convinced, one of my family members to say like, hey, I know you have a lot of money. You're a dentist. You're technically accredited and you can do all these different things. Why don't we create this syndicate? And why don't we bundle together some money and then, maybe we can invest in something, right? So looked at all the things, couldn't really do that in public markets. That led me to looking at the private markets, which was kind of like more angel investing, investing in startups and trying to figure out how to grow those startups. Eventually that led me to working at Accelerator, helping other startups, advising startups, helping them grow in operations, connecting with people, and then essentially syndicating $1 million to invest in 23 different companies. And those companies I specifically focused on were data collection, robotics, and supply chain, because I thought that would really automate the future. Out of that portfolio, 5 of them hit, and then like half of them failed after Silicon Valley Bank crashed. But yeah, I returned money back to the investors. Yeah. So I didn't try and create an emerging fund and lose all the money. They actually didn't make a whole lot of money. Returned about 1.2x. So not like crazy to be proud of. The market was about 15x, but the actual realized was only 1.2. So at the end of the 5-year stretch, I think I made like, I don't know, it was like 40,000. Then you have taxes. So like 28,000 for 5 years. So it wasn't really great. But what ended up happening was I built up a very, good track record of, what could I do for people? A good, Rolodex of people, not just the founders, but also the investors. And I made some really good connections with some of the general partners in the ecosystem, right? And so based on doing that, I had this rapport with people. And one of the general partners from Legendary actually reached out to me after, about 4 years of knowing me and said like, hey, I know you can do all these things. You're really good at working with the founders, working with startups. How can we work together? Right. And so that's how I ended up here at Legendary.
That's awesome, Ken. I think that's awesome. And we definitely want to hear more about you and also all this experience that also we want to hear Sia, also in the sales and in the leadership and the recruitment side. So Ken, your career has spanned from a lot of things, and definitely different various roles in tech industry. So how was your approach to leadership, over and how definitely evolved over the past years, starting from, at the beginning where you said, I want to do this dentist stuff, but I don't want to do this food stuff. So how actually that evolved? And then Sia, how definitely can we ensure that your sales strategy or the sales strategy from a company can align to those expectations of investors? So Ken, do you want to go ahead real quick and then we'll just go to Sia?
Yeah, in terms of leadership, I thought there was a time where I can kind of study everything, whether it's on YouTube or Google. I was very, very fundamentally book smart about pretty much everything. on venture capitalists. I really just did a lot of research, and I thought I knew everything. And the more I started getting involved, the more I realized, okay, there's a lot of things I actually don't know. Right, so that was kind of like the toughest challenge for me, because in venture, you can think you know things, but when things come up that aren't in the textbooks, you really have to either know the right people, or you have to you essentially trip and fall really fast, and you have to figure out how do you work around that to the point where if you don't find a solution, there's no plan B. Like if you're in a corporate world and you're like, hey, I messed up this job, I can go get another job, right? That's the plan B. In entrepreneurship or in venture, you mess up. If you can't solve that, the plan B is you failed, right? And then you failed, then you're essentially done, right? So you really have to figure out like how do you succeed or how do you fail? And when you're failing, there's a point where you got to figure out how do you cut your losses, right? You don't want to, like in the case of me raising the money and half my portfolio getting wiped out from Silicon Valley Bank. I didn't want to go out and raise more money under the assumption that, okay, I lost all this money, to go out and try to raise capital, because if I raised money and then I actually lost more money, I didn't actually break even. The net of it is people were like, oh, okay, I gave Ken all this money, but then I lost the money, right? I took my wins, which is the 1.2x, and I cut my losses of everything else from the 15x down to 1.2x, and at least made people happy. And then that gave me the opportunity to get to where I'm at. So there's a lot of leadership just trying to figure out, okay, how do I navigate this, and how do I work with certain people to get from point A to point B? And it was just like the only way to actually explain it is to actually do it, and then ask people that have failed, like, okay, what did you fail at, and how did you get around it? But there's literally no textbook answer on how to do it.
You couldn't be more right, Ken. I've read a bunch of books. I got my MBA before I got into all this, and I'm like, man, where was this class when I needed it? It didn't exist. My route was very different than yours. I started from the bottom of a sales company, and I learned how to sell, and then I went into leadership. And one thing I learned in leadership was they have to know and see you do it, so they believe that they can do it. And I know I'll get into this more and more, but you got to let them fail. You just how do you develop a sales team is they have to know what it's like to fall and pick themselves back up. And that's like huge. And when you're talking about investors and sales and aligning everything, is one thing that I always look for is to make sure, and if you're looking at this from the VC side, or if you look at this at the corporate side, your investors are pretty much your boss. They're the ones who you report everything to. So for me, whether it's me reporting to the CEO or it's to, XYZ fund, you need to make sure that your vision and your path are the same from on leadership. You guys may see like, hey, we both want to hit $100 million in revenue, but if you see two different pathways to get there, you're going to bump heads the whole time. You guys have to be uniform in your approach. You can challenge each other, but the approach has to be the same. That way you have the synergy and you have buy-in across the board. And that's such a massive thing that's normally missing, is you'll see a rift at the top of the pyramid where they see there's two different angles. People are going a different direction, and it ruins what you're trying to create down at the bottom with your sales teams. So I hope that answered your question, Leha, but that's definitely what I've seen on my side.
Yes, that's awesome. And it's really nice to see the both perspectives, and we already have a lot of questions from the audience. So I'm just going to ask one, and then we're just going to move on with our discussion. And Megan is asking, first of all, thank you guys for your questions. And Megan is asking, what is the biggest mistake you see businesses do when asking for funding? And hello from West Virginia. So Ken, do you want to answer that? And then Zia?
Yeah. So I think there was a time where, let's say it's like 5 or 6 years ago, when there's a lot of money circulating in the economy, where you can kind of have an idea and say like, hey, I'm going to do this idea. I'm going to talk a really big game. I'm going to say I know all these people, and then you can kind of raise a lot of money. I think now, if we're looking at the current economy, it's kind of similar to what it was more than 10 years ago, where you don't want to go out and ask for money if you haven't really proven now, like, okay, people are actually buying your product, people are actually using your product. You actually have some sort of metric where it's not just, like, hey, I talked to all these people and they said they'd use it. Okay, well, they said they use it, but are they actually using? Are they actually paying for it? And you don't need to have like $100 million in revenue to raise money. I mean, if you can get like $5,000 of paying people, which isn't a lot. I mean, it seems like a lot to start, but $5,000, if you have 100 people, right, and you charge them, $50 to sell like a gift box or something, right? You have 100 people to buy that, then there's some sort of validity in what you're doing. And so you take that and then you figure out how do you min and max that and really make it more efficient. And if you're looking at the cost to produce that product, is there a margin in, are you 2.5xing your margin? Are you 2xing your margin? Like, you have to have that room of difference so that you can say, okay, well, I buy this product or I make this product for $5. I sell it for $25. If I sell enough of these products, well, I have all these other expenses like my website, my, paying my staff, paying for all these other things. At the very end of it, am I break even or am I at negative, right? So in venture, we look at things called like the EBITDA margin, earnings before taxes, interest, depreciation. And if you look at it and you're like, okay, well, if this company is negative 10% EBITDA, I mean, they're pretty close to break even. Okay, yeah, I'll look at that. But if you look at a company that is like negative 50%, at least to me from the financing side, it's kind of like a red flag, right? So let's say you make $10 million in revenue, but like you're losing $5 million a year. Okay, well, that's kind of a problem, right? Because when I go back to my LPs and I say, hey, this company is really great, love the founder, the product has validity, they have high revenue, but then they say, okay, well, what's their EBITDA margin? I'm like, okay, well, they're kind of like really negative, right? And then the next question is, well, how much money did they raise? Okay, yeah, they raised $60 million. Okay, well, they raised $60 million and they're doing $5 million in revenue. Okay, well, are they very deep tech, which requires a lot of capital expenses? Well, no, they're kind of like some AI company. Okay, well, there's some AI company which, okay, well, if you have that and you look at the general investor's mindset, it's like, okay, well, why would I give this company $60 million to only make $5 million in revenue? So I'm at a negative $55 million and I don't know what the next 5 years is going to hold, right? So they always come back to me with the same concept of like, why would we give them $60 million when the average McDonald's costs like $1 million to set up and at least does 1.3 million on average in revenue, and you take home like 100,000, right? So why don't we just buy 60 McDonald's, right? And we take home that profit. That's just way more like it makes sense, right? Because at the end of the day, my job in finance is really to protect our LPs, and they give me money, right? So if you think about this concept, they give me money, I give them more money back. That's as simple as it is. As long as I can like withhold with that fiduciary responsibility, nothing else really matters. I can bring whatever deal and they say, okay, great. If you mitigate all the risks and you say you're like 80% sure, I give you this money, you give me some more money back, then let's proceed. Right. So if you think about it from that lens on the financing side, and you look at EBITDA margin, you look at like, okay, like what are these companies doing? There's a timing frame where, okay, is this company, like they sound so great, they're just not at the right time, right? And that's because maybe they haven't figured out how to get profitable. Maybe they're still burning a ton of money. And so when you look at like how financing works for raising capital for startups, the very early stages is really like the angel investors, the friends and family that they don't really care about your EBITDA margin. They don't really care if you break even. They love your idea, go build it. Right? But when you get into venture and VCs, I mean, we kind of have a little bit more of a higher profile LP client where our only job is give them more money than they give us, right? Because if we start losing their money, well, then we lose reputation as a firm. And then on top of that, when I go out and say, hey, this is our track record, this is our IRR, this is our DPI, this is all the metrics we have, and I want to raise for the next fund, well, the future LPs are going to laugh if we don't deliver, right? If we're not returning money, no one's going to invest in our next fund. So that's kind of an issue that I've seen in the past decade where, there used to be a lot of emerging fund managers, a lot of VCs when all the money was, there's a lot of floating money around after the big IPOs from 2018 from like Uber, Etsy, Airbnb, Tinder, etc. But when you started moving into like today's standard after, all the market crashes, all the economy crashes, COVID and all the inflation, and you start looking at, okay, well, there's not as much money. So if there's not as much money, but you have all these competitors still trying to raise that money, whether you're from the founder side or you're from the VC side trying to raise money. Well, the people who have the money only want to have safe investments, right? They want to invest in the VCs that, they have at least some sort of track record. They're not losing money, right? And so that's how you become a notable VC, right? So most VCs have figured out how not to lose money, even if it's not, I'm returning 10 or 100x to my investors, I'm returning 3 or 4x. Those are the VCs that make it past 10 years, right? And so if they make it past 10 years, okay, well now their strategy kind of, as they grow, strategy kind of changes. But really that's the general concept is they give me money, I give them more money back. And so if you think about it from my side, it's how do I protect my investors? And if you can convince me I can protect my investors, then you can get money from me. It's a very simple process.
And if you look at it from the other side of I think the question is, what mistake do businesses make when they're asking for funding? Is I would tell you, don't look for just the money side of it. What other resources are they bringing to you? Are they bringing mentorship? Are they bringing marketing? Are they bringing operational efficiencies? Are you looking at a partner or are you looking at a bank? I know for us, we're in acquisition mode. So what we look for when we're going to buy a company or if we're going to partner with somebody is how can we leverage each other's resources to grow something bigger, stronger, and faster? So I think that I hope that helps Megan out with her question with both of our answers. But I'd say look for a partner, don't look for a lender. And sometimes the most amount of money may not be the best option. So hope that helps.
In other words, that's awesome. In other words, talking about it, Jacoby has another question to both of you. And it's more about if you guys have any website or books you guys can recommend that if had helped both of your businesses. Sia, do you have a book in mind?
Yeah, so with me, I love Patrick Bet-David, and he's written 2 really good ones. One is, I got it right here. It's called Your Next 5 Moves, and it's just really all about being smart with strategy and what you're going to do next. It really helps your planning and putting together the proper plan and always thinking ahead. And his other one is Choose Your Enemies Wisely. And it's really about staying motivated and making sure if you're going to pick a fight or if you're going to go after something, make sure you're not wasting your time with something that really isn't worth your time. I love those 2 books. I think they're great. I highly recommend them. I think the guy's a genius. I mean, he sold his business for, I think, $500 million or something. And he's still looking for more new stuff to do now. So I love that guy.
Ken, do you have any book or website in mind, or did you actually had a mentor that you had in the past, and it helped you through what you are right now? I think that's actually Joshua's question. No, actually, it's Jason's question. And it's about if you ever had a mentor that helped you go through some of your failures to move forward. Is that makes sense? Like, do you have a mentor or maybe the book or a website that you usually regularly just look?
Yeah. So I had 2 books. And then I have one mentor that, I had multiple mentors, but there's actually one mentor that, really helped with my development. The first 2 books, one is 0 to 1. That's by Peter Thiel. I know that's kind of like a very mainstream book that a lot of people kind of read. I have it over here on my shelf. I just don't want to get up and get it. And then the other one, we have Blitzscaling by Reid Hoffman. It's a red book. It's kind of like the founder, the founder journey. How do you actually go and get a bunch of people to use your product and just grow, right? So those kind of gave me the fundamental knowledge, and so back to my original background, I was like, okay, I got the fundamental knowledge, but really, the general partner of Legendary, Jason Kim, he was really the one that really pushed me towards, outside of fundamental knowledge, how do you actually do this from a business standpoint? Because all that stuff, in the textbook makes sense, but in different scenarios, you have to really think critically. And, sometimes I just don't know the answer, even though I think, it's like, okay, I think this is the answer. And I tell him, he's like, okay, that sounds like the answer, but, from my point of view, that's not the right answer. And so what I realize is the difference between the books and the difference between what he's done and how I'm learning the experiences is he just has a very large, robust experience of, okay, I've done this, right? So even the textbook says this, even if someone else says they've done it in this way, based on my experience, there's a probability, right? So these guys may have succeeded with a 20% probability, right? And that great works really great for them. But based on what he's done, multiple projects, 80% of the time, it'll be more likely if we go this route, right? And so from thinking from the VC mindset, it's like, okay, if it's 80% more likely to go this route, even though the odds of it being successful is not as impactful as this other 20% high risk, high reward. I look at it from that angle, right? And so, gosh, I can write like a whole summary of literally every single thing that he's, kind of pointed out, that if we look at a company, you should do this because it's more likely, right? And so I think, understanding that mindset from a mentor who's been there and done it and has the probability, and think about this, not just if you're a founder or if you're an investor, but think about the probability of doing something. And for that probability to be more successful, you always want to play the odds of more successful because it's a long-term game. Whether you're a founder or an investor, it's not just, I want to gamble roulette and I'm going to get like 20 to 1 odds one time and I'm going to do it again, I'm going to lose all my money. It's okay. You're building your reputation for yourself, whether you're, if you're a founder, your journey is going to be like 10 years. If you're a VC, it's 10 years as well, because you have the 10-year life cycle of the fund. And so it's like, how do you survive that marathon where, okay, I made some money, I exited my company. I didn't have to be the next like Uber, Microsoft, or whatever. I made a lot of money, not billions, but a couple of millions. And then maybe I can go do it again, right? Because then I have a lot larger of a safety net, a lot larger of a cushion. I don't have to worry about the headaches of money because I made a couple million from exiting a company. And then I can do all these things, right? So when you have less headache and you have more experience and you have people to kind of say, hey, don't step on that trap because the odds of you, getting pinched is much higher. That will save you a lot of money, save you a lot of time. And, it will make you significantly more successful at what you do, right? Like, it's like, the best example that I've kind of learned is like, if you want to be a really good basketball player, right? You don't want a coach that's never played basketball, that only knows basketball from the books. You want to find someone that's actually played before, or you want to find a mentor that's, Michael Jordan, right? You don't want to have some no-name guy on YouTube that, talks about how you can make the perfect arch to shoot a 3-pointer, but you've never seen a video of him shooting a ball, right? That's kind of like the scenario. You have like, it's just really helpful when you find the right mentors. It's really helpful.
Yes, Ken, thank you so much. And now let's move forward a little bit. You have a lot of experience in the tech background as well. So let's just talk a little bit more about the future, and investment. And it's more about what emerging trends do you think will significantly impact how leaders approach scaling their companies and working with venture capitalists? And also for you, Sia, how do you see these trends influencing the recruitment strategies for tech companies and that they need to adopt to stay competitive? So do you want to start maybe, Sia, with how these, AI, different technology trends can impact at this side, and then we'll go with Ken?
Yeah. So anytime I see something changing in the market, I always think of the company BlackBerry. BlackBerry was like it. It was the coolest company. They had the best phone. Everybody had one. And I felt like they just watched time change and made no reinvestment in R&D or the proper R&D. And you saw them disappear. And you saw Apple take over, Samsung take over, even Google's got a decent market share. And when I look at what today's market looks like, there's two things that come to mind. I'm sure Ken's going to talk about AI, and so I'll leave that one to him. But AI is that's changing every day. We are at this is like the internet boom in 1992, where we're like not even sure what it is. And once we kind of get a hold of AI, if you've missed this train, it's already over. But on our side, what we see and what we're seeing a lot more of is what we call the global employment. instead of local employment. One of the things that makes our company special is we have an incredible niche to find fantastic talent in the LATAM area. So we call that nearshore. And if your company is in IT, if you're in development, if you're in any sort of information technology, and you are not utilizing nearshore technology, nearshore people, you are going to be left in the dust real quick. And we see a lot of our clients that are continuously growing. They're defying the interest rates. They're defying the recession. They're defying everything. It doesn't even matter to them because they're investing in the right places. And one thing I tell everybody is, I tell all of my friends that are in IT who want to be remote, I say, guys, enjoy this while it lasts. Because if you don't come in the office soon, they're going to replace you with somebody who is half your cost and overseas who's doing the exact same work. So the two biggest changes, again, AI, and we don't know where that's going to take us. And then two is got to be your workforce, your global workforce, and just realize what talent is where, what you're getting, where you're getting it, and how can that fit what you're trying to do moving forward. Because if you're spending $250,000 a year for an architect, when you can get it for, I don't know, $90,000 a year overseas, you're going to get beat out because your margins are going to be thinner than your competition's. That's the biggest trend I see. And Ken, I'm going to pivot to you because I know you're going to get into AI a little bit. So I'll leave that for you.
Yeah, I get this question asked a lot. I think, AI is one bit of it. I think overseas staffing or nearshore staffing is another bit of it. When you look at very large corporations or, companies in general, everyone's always trying to be more efficient because at the end of the day, the more efficient you are, the more money you can squeeze out for the executives. And then everyone else, maybe you get some crumbs or bonuses or whatnot. So it's a matter of, okay, if large tech companies want to be more efficient and the cost of living goes higher and higher, and then you have to, and then you see the shift of COVID and people want to be remote, and then you have all these office spaces closing down. You have WeWorks shutting down because it's just not as efficient to have a bunch of physical locations. Then you start looking at how do people, not necessarily cut corners because they still want quality, but how do you have at least, let's say if you're benchmarking, you say you have 100% efficiency. How do you go from 100% efficiency to maybe a 95% efficiency, but still deliver the same value to your customers, but drastically increase your margins? Right. And I think with AI, a lot of the larger companies can do that. Now production time is maybe a little bit longer if they use AI because there's still going to be some bugs, but they can essentially reduce the amount of people they need to do a project. Right. So I've seen some projects that used to require 15, 20 people. I mean, now, if you have really, really great engineers, but they're really expensive, then you can kind of reduce that down to 10. But I think with the development of AI, you can probably reduce that even further, maybe 5 or 7 from the 15 or 20. And so what you have is a net is, okay, well, we don't have as much benefits to pay out. We don't have as much, headache. If someone gets sick, can we still move forward with the project? Well, yeah, because we don't need all these people. So that I think that's going to affect larger corporations. I think smaller and mid-sized corporations, they're going to use some AI, but I think with, what I've seen in the market, they'll probably look more towards, nearshore or offshore or some sort of lower development because, most of those companies, they have a product that works. They usually need somebody to just maintain it or maybe add a couple of features. They're not building a 0 to 1 product, a company with a product that's kind of an idea to building it to $100 million business. These are companies that they have 10, 20, $40 million in revenue already. They just need to add a couple things so they can go from 40 to maybe, their annual 2 or 3% growth. And those companies are still happy, those small and medium sized, businesses. But I think with larger corporations that are multi-billion-dollar corporations, they have shareholders, they have executives, they want to essentially min and max. right? So I think those are the ones that are going to heavily affect AI. So I don't think that means that jobs are not safe. I think there's going to be less jobs in general, but I think it also means that, within those less jobs, it gives people the opportunity to figure out, okay, if I'm in tech, what type of tech do I need to focus on? Like, is it more of like coding,
Hmm.
or is it more of, okay, I want to be more of like a hardware specialist, or more of a test engineer instead of like a coding engineer, right? So there's different branches. I think, like, that's one of the big factors. I don't think a ton of jobs are going away, at least not for another like 15 or 20 years. I think in 15, 20 years, if not just AI, I mean, AI is one bit. If robotics actually gets to where I think it will be, which is, it's always my thesis, like there will be humanoid robots that can automate a lot of mundane tasks that people don't want to do. I think then those tasks that are, they can kind of inhibit someone's safety. Um, like it's just, there's like a lot of weird tests. Like for example, there was a robot that essentially flips hamburgers and runs a fryer, right? So in a restaurant industry, if you have a person that has to run the fryer and they're kind of the cook, and have to pay more, then you have more like liability insurance in case they get burned, and there's like workman's comp. And then you see like robotics where people are lifting very high, like very heavy objects, and if the object falls, there could be a fatality, right? So then you have robots that can actually automate those things for safety and compliance. I mean, a lot of those mundane jobs will be, just obsolete because robots just make it safer. But
Yeah, and
the flip side,
it's happening now. Sorry, Ken. I just to, say something. I used to work
yeah,
for a robotics company, and it's crazy how in the, restaurant industry already you can see a lot of robots doing deliveries. It's just insane. And then obviously that's where your question is. The jobs, for example, of the person doing, putting the plates inside of the table definitely change, and now it's a person doing the menus, or it's a person trying to, do a better customer service rather than just putting the plates on the table, because we already have a robot for that. So it's at that level, and exactly what you are saying, it's so here. And I think the future of those changes are happening right now, and you can see them like everywhere. So you are totally right for that, and it's very, very nice. Just because we have so many questions and I want them for you to answer them. We have a question from Joshua, and it's to you, Ken, and he's asking, how can startups maintain growth with less access to venture capital?
yeah, I think growth can be measured in two different ways. One is, okay, I'm going from $1 million to, $5 million, right? That's kind of like a growth. Like, okay, I 5x start revenue. The other way of doing growth is not necessarily like 5x in your revenue, but it's making yourself more efficient, right? So what I mean by that is, okay, well, I have $1 million in revenue, but my take home, our net is like 20K. Well, that's great, but it's not really making money. But if you can figure out how to either, if you have to minimize staff, you have to put people on, kind of like part time, and you can get that $1 million revenue to maybe next year it goes like 1.1 million, or even if it stays flatline 1 million, but you can get your net profit to go from $20,000 to 40 or 100 or $200,000. Well, that's also growth, right? Because with that additional money that's not getting burned, it's more money in the bank, which you can use for cash flowing into next year. You can use it to build more products. You can use it to hire a sales team. So really, when you think about it, like, it's very different for every business. So like some businesses, especially a lot of startups that I see nowadays, they have a really good product, MVP level. They can sell it, and they're like, yeah, this is the best product. I'm going to keep building this product. I'm going to invest. I'm going to raise money. I'm going to invest more money into building this product, right? So the product itself at the MVP level is already generating revenue, already quite, it can be profitable, right? But what they do is they just keep spending more money and hoping money fixes the problems, and they keep hiring engineers, and then they build a completely, superb product, but they don't have the team to actually back selling that product. And sometimes they actually over engineer and build more products that the customers don't even care. So they don't even care. Then you wasted all this money to build something that they don't even need. So if you kind of, it's like counterintuitive, but if you slow development and you actually ramp up sales, if something works, even if it's not, like I said, it doesn't have to be 100% efficient. If it's like 85, 90, 95, it works good enough where it solves whatever problem the customer has, and you just ramp up sales and you push out more sales demand, then the revenue comes. And the revenue comes and you're already figuring out how to be, kind of profitable. I mean, there comes a point where you just don't need to raise money, right? And it's like a weird thing for a VC to say, but at our firm, we always tell founders, like, or we ask founders, like, why do you need the money? Right? Because if you just do this, this, and this, and it's weird because we try to push founders to not raise money. Right? Because if you raise money, you have headaches. Then we have to request fund reportings from you. Every quarter we have to request updates. We have to do all these things, and it kind of like inhibits you in a way because you're like, okay, well, I got to do all these things before I can get this money. I got to do all these reportings, and it's like, no, we want you to succeed. But to succeed, we give you this general outline of do this, make yourself profitable or make yourself closer to profitable, because not only does it help you, but it also helps us, because at the end of the day, the only way we make money is if you can exit, right? So if you can't get profitable, then you can't get, if you're not profitable, you just keep raising money and you're losing money. Well, our risk is higher. And on top of that, as a VC, if I lead you around for investment, I can't go to other VCs and, I'd have to half-heartedly say like, hey, I want to raise money for this company so I can get a markup. No, I want to actually be wholeheartedly saying like, look, this is a genuine company. I'm leading the round on this company because of these benchmark metrics. I believe if we give them, $1, they can take that $1 and they can make $3. So they're going to grow, right? And that plus the reputation that we have, plus, all the other connections and things that we can put together, we can kind of financially engineer your raise where, if you're not profitable, if you're not doing all these things, it could take you a year or 2 years to even raise $1 million. If I can get you to a certain benchmark level where I can tell a good enough story to other investors, you have what's called, the sheep herd mentality, where it's like a weird, like, oh, this VC said this, and they're doing this, and they're saying like these numbers make sense. All the sheep flock to it, right? So I can just say whatever, as long as it's from a valid source, because we're reputable VC, but it's a validated source. We have all the numbers to support it. You also have the metrics to support it. And we give you like, I don't know, it'll give you like $200,000. Well, you can raise that $1 million round in like maybe a month, right? So you see the same thing. You see a lot of founders that can do that. They get, even if their product, like I've seen this, and, some people will like flag me for saying this, but I've seen products where the founder is kind of a cool person. The product sucks. Some VC said, hey, I gave you 100K, and then they go out and they raise like $4 or $5 million. And like most people are like, this founder is telling this pitch, I don't even know what they do. I have no idea, right? So on the flip side, what we do is we don't do that because we don't want to play that musical chair game where we have no idea what we're investing in. We want to know, like, if you can get this level, like I don't even care if you only do $500 a month in revenue. If you can do $500 a month in revenue and you can take home $400, that's enough to convince me to say, okay, how do we help you go from $500 to $10,000 a month? And then how do we do that where I can invest something? I don't know what it could be. I mean, I can invest something, and then I can help you get to $1 million in ARR or $1 million in revenue. And I can, kind of FOMO other sheets to invest in your deal so that I can get a markup, right? Because the markup means, hey, I'm X amount on paper. And then if you do that enough and you can actually get profitable, well, the FOMO game of raising money helps you become profitable if you understand how to play the game, right? How to actually become profitable, how to become, squeezing margin. And if you do that correctly, then your growth starts going up, right? If your growth starts going up, well, then I can easily go out and raise more money. And eventually someone's going to say, hey man, this company, they're doing $50 million in revenue. Can I buy them? Okay, then that's literally a payday for you as the founder, because I can exit you, and that's a payday for me because I can then go, negotiate those terms. We can settle for some type of exit. My LPs are happy. So my LPs are happy. Then, what I'm going to do is I'm going to come back to you and say, like, look, I scratched your back. I helped you get from point A to point B. You had some sort of exit. You know, you made $50 million. You know, when I raise this next fund, can you help LP into our next fund and also help our future founders so we can pay it forward and we can actually grow an ecosystem to raise capital? And I think that's like the mindset of how I want to do it. I know other VCs do it a little bit different, but you know, at the end of the day, it's all about the odds. If you can figure out how to be like profitable, then it's a completely different story than raising on an idea, because I don't think,
Right.
you know, it's not 2010 anymore. You can't raise on an idea. It's almost impossible. Not from VCs, at least. Maybe angels.
Thank you, Ken. Now, Zia, we have a question. Is actually talking about how do you approach the innovation for these emerging technologies and the things that we're talking, Ken, before, but in terms of recruitment and leadership, you know, with all the innovations, how can you adapt that to your work?
Say that one more time. You were breaking up a little bit.
Oh, sorry, I think it's my internet connection. So the question was from Jason, and it's actually how do you approach innovation in your work and what emerging technologies excite you the most? And I think it's most about, you know, from your side in the recruitment side, but also on the leadership side, what would you do? What will you approach? How will you approach those you know, technologies?
Okay. So we are also sniffing around the very beginning of AI. We have a team down in Colombia that's helping us automate a lot of our processes. And what they're doing is they're building out an automation system that helps manage the funnel of candidates. So it'll vet them out. It'll make sure before it even gets to our desk, it's already met the minimum criteria that we're looking for. And what that does, kind of like what Ken was saying before, is it may not grow revenue, but it'll make you that much more efficient. So you're still growing. So that helps us out a ton. So we're putting some money behind that. It's helping us facilitate that process. I think the next part that we've got to go after is it's got to be more along the lines of client acquisition and how can we use AI? Because the last thing I want is I don't want to hear a bunch of spam phone calls, spam emails. We're looking into what is going to be a way to make sales, one, less salesy, and then two, more efficient. And once I think that's the next part that we're working on is client acquisition. We're very, very good at getting candidates and finding the right candidates. The next step for us is definitely going to be client acquisition and to continue to grow the company. We're very excited about it because we figured out for everybody else, we're going to be doing just fine. So it's going to be fun, but it's not easy, which is, if it was easy, everybody would do it.
Thank you, Zia. And then we have one question from Mina that I want to actually ask. And it's Ken, he says, hi there, I've been turning since the Gen Z podcast, Zia, that we did previously. And he wants to know, he has 21 years old, and he wants to know what do you advise or what do you wish you will have invested at that age?
When I was 21, Google, Google would have been great. Apple would have been a pretty good one to have got into when I was 21. But you're gonna laugh. Of all the investments, like those are the cop-out answers. Invest as much as you can in yourself and in your inner circle. I heard a great quote. I think we talked about it on one of the podcasts. Is you are going to be the average of your top 5 people you hang out with or the people you associate with. And I would say, especially when you're 21, you're like Play-Doh. You can be molded into anything at 21. And I would say invest in yourself and invest in the people you surround yourself with. Surround yourself with people that you want to be more like. And that doesn't mean professionally all the time. Sometimes, like for me, as people often tell me, I'm a little rough around the edges sometimes, and I'm a little difficult. So I try to surround myself with people that are pleasant all the time, people that are very optimistic, very always positive people, because you see that rubs off on you. You want to surround yourself with people that bring out the best in you. And what you'll see is it has a direct reflection on everything you do in your life. So that's a great question for me. And I wish I could have remembered that or done that when I was a kid. Invest as much as you can in yourself, and that goes mind and body. Keep yourself in shape, keep your surroundings clean, and keep the people around you positive. Good things will happen.
Ken, what about you?
Gosh, and that's kind of a tough one.
It's Google. Let's be serious, man. It's Google.
I mean, Google would be nice. I think 21. I mean, that was a little more than a decade, but I mean, wasn't old enough to be around with Google. Um, Gosh, I think within my time frame at 21, I don't know, probably OpenAI.
Yeah.
OpenAI would have probably been a really good one. I think I kind of like saw that. I've seen like some posts about it like early on. I had no idea that AI would be a thing. I mean, I did, but it wasn't as apparent as what it was now.
Thank you, Ken. And I want to finish this podcast. Thank you, everybody, for all your questions. I'm so sorry if I wasn't able to answer all of the questions. If you have questions, please go to our LinkedIn. Everything is live stream, or please tag Ken. He's there in our LinkedIn too. He will be more than happy to answer your questions. But I want to finish this question to both of you guys. And it is from Nazanin. And the question is, what important characteristic help you become a successful investor, Ken? And to you, Sia, as a good, a salesperson. So who wants to start?
Ken, you're the guest. Take it away.
Gosh,
Ken,
can you repeat the question one more time?
what
I just,
important characteristics help you become a successful investor?
gosh, that one's really hard. I think the biggest thing is you have to have a I guess it's on my LinkedIn. I mean, like you have to have what I call a passion for what you're doing, right? I mean, because there's like so many different skills you can learn. Doesn't matter. Like I self-taught myself how to code, right? And I launched an app in the App Store, iOS and Android. Like that has nothing to do with my background, right? So I think you can learn all those skills, but I think to be a really good investor, you have to be genuinely passionate about wanting to find the needle in the haystack and wanting to either help the founders or build something really, really great and be a part of it. Because there's going to be a lot of founders that you reach out to that say, no, I don't want to work with you. Or you reach out, and this is on the VC side, right? Founders say, no, I don't want to work with you. I'm like, why not? I think you're going to be a really good deal and I want to make money, right? I don't tell them that, but they're like, no, we're too exclusive or whatever. That's something that does happen. On the other side, there's also LPs that do the same thing. Like it could be family offices, it can be people, the money's everywhere. But the problem is not everyone wants to work with you. And it's not because, you're not a good person. It's just one, maybe they don't know you. Maybe it's the trust issue. Maybe it's like, hey, I just met you. You can't ask me for, $1 million. It doesn't make sense. Right. So you have to be very passionate about that and work on building the relationship with the founder, building the relationship with the investor, and eventually getting to the point where you ask the question. Because eventually you have to ask the question. It's just like sales, right? You can butter them up, you can wine and dine them. But if you've never asked the question, then you have no idea whether they'll let you invest, whether they'll give you money, or whether they'll even buy the product. Right. So it's a very like interesting cycle where you ask all the right questions and you have to be persistent and you have to really just build that relationship to figure out, okay, at the end of the day, after them getting to know me, from a relationship standpoint, do they want to work with me? Because if it's a it's like a one and done type of deal, and they met me for the first time or I met them for the first time, the odds are they're not gonna they don't want it, right? And then they have to really, like, both sides have to want it. The founder has to want to work with us. We want to work with the founder. The LP wants to work with us. We want to work with the LPs. It's the same in when I did sales. It's most of the sales that I've ever done in my life were not necessarily because the product I was selling was superior to the competitors. It was really because the end client had a problem, had a solution for the problem, and they trusted me and they liked me. And because they liked me, I was able to sell it. I mean, that translates directly into venture.
Sia?
On my side, for doing this as long as I have been doing this, the number one characteristic I would say has got to be perseverance. And Aleja, you always ask for a quote, so I'm going to give you one. Failing is not the destination, it's part of the journey. And especially with what we do, we will fail or we will stumble almost every single day. And the difference between the people that make it and the people that don't are the ones that allow the failure to get to them versus the ones that use that failure as motivation and as fuel to get to the next step. And for me, that's what it is. And let me tell you, I have failed more times than I'd like to admit, and some stories that I'd rather not share. They're embarrassing half the time, but the beauty of it is just don't make the same mistake twice, and it's not technically a failure. It's not technically a mistake. Mistakes when you do it more than once. So that's what I've seen on my side is don't ever get down, no matter how bad it is or how gloomy it is. I mean, hell, we had a really rough week last week, and we all could have just packed up our bags and just gone home. And I think it was funny. I was telling the story. Like I have a TV in my office, and it was off, and I saw my reflection. I looked at the TV and I said, "So what are you gonna do?" And we flipped the switch, and boom, the thing started taking off. It's just all mindset. It's saying, "I'm not gonna get beat. I'm not gonna lose," and you just push forward. Perseverance is huge, especially in a smaller company, especially in a startup, or it just when you're in a big corporate environment. If you fail, nobody even knows. When you're in a small company, if you've got 2 eyes looking out, you've got 50 eyes looking back at you. So it's tough. So it's being able to persevere, having the confidence in yourself that you can do it, and then having the guts to go do it. So that's what I've got.
Sia, Ken, and thank you so much, guys, for joining us today. I know this podcast should have lasted 3 hours talking about AI technology and everything can with you. It's also a very nice, personal, like about robotics and stuff. And we will be more than happy to have another opportunity talking to you about that. So thank you so much for your time. Thank you, guys, for your questions. Thank you, Sia. Stay tuned for more podcasts coming soon. We also have other type of guests talking about empathy, engagement in the workplace, talking about HR, talking about a different stuff that we are doing in the different industries, and also for recruitment, sales. Don't forget to follow us. We are at CTI Staffing. Don't forget to follow Ken as well on LinkedIn. And thank you so much, guys. Thank you for this amazing podcast. We'll see you in the next one.
Pleasure. Thanks a lot, Ken.
Thanks.
Bye bye.
Bye, guys.
Bye, guys.